Hi and welcome to Swissquote's Daily Market Talk. It's Friday, April 11th. Another hectic week is coming to an end. Uncertainty and volatility ruled this week and spread toward the sovereign bond markets amid the trade ping-pong, the escalating tensions between the United States and China over the tariffs, and projections of higher inflation and lower growth for the US economy. Now, euphoria around Donald Trump's 90-day pause to his tariffs was big, but it was also short-lived, so we were back to red yesterday. So the tariff pause optimism didn't last long. Although the European markets followed the US to the upside and jumped, a mood that was souring for the US futures since the early hours of yesterday turned increasingly bad and led to another wave of sell-off in US equities as the trade war between the US and China just escalated. China said that they will restrict the US movie imports as the US increased its tariffs on Chinese imports to 145%. As such, we had quite a divided picture at the end of the day yesterday. The Stoxx 600 index jumped open the session but erased gains as the session went on and closed with a 3.70% advance. The S&P 500, on the other hand, gave back 3.5% yesterday. The technology-heavy Nasdaq also tanked more than 4% as Dow Jones Industrial Index fell 2.5%, shedding more than 1,000 points just yesterday. And on the individual level, Disney lost 6%, while the owner of Temu, so the PDD, Pinduoduo, lost by a similar amount, suggesting that everyone will be worse off at the end of the day due to this tariff war. Gold, on the other hand, soared past the $3,200 per ounce level as the US dollar tanked big. The euro dollar soared to 113.85 level and is consolidating a touch below the 113 level this morning at the time I'm talking here. Now, the futures are slightly in the positive at the time of talking, but not that the US sell-off actually accelerated after the European market closed yesterday, so there could be a certain catch-up today in the early hours of trading. Broadly speaking, the direction remains pretty clear. As I always say, big jumps are as disquieting as big sell-offs. A 3 to 4% rebound for an index is hardly sustainable when investors remain quite worried about the trade war uncertainties and their potential implications on the global economic growth and inflation and also on jobs. So we are not out of the woods just yet. And this is the message that investors emphasized yesterday. The broadly softer than expected US inflation data that came in yesterday hardly saw any positive reaction from the markets and investors. But the data itself was unusually weak, and that's good news. Both headline and core inflation in the US came in softer than expected by analysts on a yearly basis. And on a monthly basis, the headline CPI for the US printed a negative number for the first time since July last year. And the services inflation, excluding housing and energy prices, also fell. So that's also very encouraging. The latter would normally boost the dovish Federal Reserve expectations and also boost risk appetite among investors. But no, not this time. The US 2-year yield actually remains under pressure below the 4% mark because of the rising bets that the US Federal Reserve will soon do something and step in, but the latter doesn't necessarily bring appetite along. In fact, the tariffs are expected to fuel inflationary pressures and limit the Fed's action scope, while Amazon clearly warns that US consumers will see the tariffs passed on to them. Last year, in numbers, the US imported around 440 billion US dollar worth of goods from China. So good luck for replacing them with equally cheap options for US consumers. Again, an iPhone produced in the US by Americans as Trump wants would apparently cost something around $3,000 It's 3 times at least the amount that it costs today. So if Trump doesn't care, people might, and that's why China is willing to let the tariffs hit consumers in the US so that the US could make a U-turn on its tariff policy because Trump would lose his popularity. And lower spending could help tame inflationary pressures on the other hand, but wouldn't boost growth. So that's not the best option either. And the latter is causing obviously stress and volatility in the market. And more importantly, the volatility that we've been seeing in the equity space is spreading to the bond space. And the fact that the volatility across the government bonds in the US is rising is not good news at all, because rising volatility and the falling US Treasury prices hit the pockets of the market that you want to keep safe, like the pension funds, for example. So these are sensitive pockets of the market and you want them to be safe. So I believe that if Trump backing down on tariffs can't calm the market's nerves, the Fed will be the next to step in. And in this context, this is what the Bank of England did this week. They temporarily stopped the sale of long-dated bonds in the context of their quantitative tightening program to ease the pressure on the gilt markets. In the US, well, we haven't yet seen an encouraging stabilization across the US Treasury markets following Donald Trump's announcement that there would be a 90-day pause to the tariff policy. The US 10-year yield rebounded yesterday back to 4.45%, looks slightly more stable there, while the 30-year yield is consolidating below the 5% mark this morning, but the tensions remain high and the risk prevail. Now, investors also flee the US bonds, mind you, on fear of exploding US government debt due to Donald Trump's tax cut plans. If you haven't heard, well, the US Senate passed this week a budget plan that actually clarifies parameters on the upcoming tax cuts that will benefit to the rich and corporations and the debt ceiling increase. Now, Bloomberg estimates that the changes that could allow the US government to deliver 5.3 trillion US dollar worth of tax cuts over the next decade, which is really not bad at all, and raise the debt ceiling by 5 trillion US dollars. So tax cuts are good for corporations, as I said, and their valuations. But if the yields in the US must rise in return, well, all that positive impact is thrown under the bus. So it is up to you, people, to play along Donald Trump or not. If you want to allow the United States and Donald Trump to put in place these plans, you can continue to buy their government bonds. The more you buy the US Treasuries and the government bonds, the cheaper and easier it will be for the US and the Trump's government to cut the interest rates and to spend that money. Or this is what's happening with many investors right now around the world. You repatriate your funds to alternative markets, to alternative places, and Germany stands out as a potential winner here despite the monstrous government spending plans that they announced to increase security and infrastructure in Europe, and the US Treasuries see their safe haven status deteriorate. So if that's the case, well, concretely, that would mean that it would increase the yields in the US and hence increase the cost of funding the US government debt and the US government plans and the tax cuts and all of that, as interest payments on huge debt increase when yields stay higher, and the latter could eventually stop Mr. Trump from bettering the world economy by giving US less financial power. So we saw this week that Mr. Trump wouldn't care about anything or anyone, but he cared about the sell-off that we saw in the US Treasury market. So it's up to the market and investors to give power to Donald Trump's America or take it away. Now today begins the US earnings season. Big US banks will be opening the dance today with their first quarter earnings and also their projections amid the trade uncertainty and the severely deteriorating growth projections for the US economy. And the projections will take the center stage at this earnings season and probably shape investor sentiment. Now we know that the forecast will be revised lower obviously, but how low remains yet to be seen. TSM, for example, reported stronger than expected sales in the first quarter of this year. Sales there actually increased by a whopping 42% in the first quarter of this year. That's the fastest increase since 2022. Normally, such an update would boost appetite for Nvidia, for example, and it certainly limited losses, but Nvidia still closed yesterday's trading session nearly 6% lower as no one one at this moment knows if Taiwan, for example, would avoid import taxes from the US, even with TSM's pledge to invest up to 165 billion US dollars in the US. I guess we will see. So this is all for this hectic week. I'm İpek Özkardeşkaya, and thank you for joining me, and thank you for all your beautiful and supportive comments. I hope this episode of Market Talk has been helpful and it has been insightful to you. So please do not hesitate to leave your comments, your reactions, and your questions below as usual. Follow us on Instagram, on X, on LinkedIn, but also on our new WhatsApp channel, Threads, Telegram, and Blue Sky for regular market updates. Subscribe to our YouTube channel for daily market comments, and please don't forget to hit the like button on these videos to let us know that you enjoy them. So I will meet you again next week, and until then, good day trading and have a lovely weekend.